Our fourth theme on fixed income is the growing debt and the shrinking tolerance. We've discussed how we think the expansion can continue. We've also discussed that reflation is a major risk for this year. What does that mean? Don't expect interest rate cuts. And when we're looking at the Treasury yields right now, we think it's too optimistic in regards to where the Fed can go this year and not pricing in at all the risk that the Fed can increase interest rates this year. It's also not reflecting any chance that we could see inflation scares this year. So for that, we are cutting our duration within our fixed income now to underweight. We've been overweight our benchmark for the past 3 years. It's time to cut that duration. We think that not only inflation scares, the expansion that could continue, but we did see some evidence last year of investors growing less tolerant for these outsized debt ratios that we're seeing, not just here in the US, but globally. And lastly, don't forget that deglobalization comes in a lot of different shapes and sizes as well. When you see investors in other countries that can now get yield in their own country, they may not be as inclined to come to the U.S. and buy U.S. bonds because now you're taking currency risk they may not need. So we think this is all going to result in a lot of volatility in long-term rates. Cut duration, we're eliminating our exposure to emerging market bonds after the major run-up we saw last year. And when you look at this chart, emerging market bond spreads, or that extra yield you earn over treasuries, is now the lowest level we've seen since before the great financial crisis. So there really is no risk reward left there. They also carry a higher duration as well as a lot of interest rate volatility. So we're eliminating that position.